All right, welcome to this explainer. Today, we're diving into a scenario that's honestly both fascinating and kinda terrifying. Think about it. What if the absolute biggest boom in modern technology turned into the next great bubble burst? What if all that endless spending, the soaring confidence, and the relentless hype that literally built the AI era suddenly became the exact thing that makes the whole foundation crack? Right now, we're living in a world where pretty much every company, investor, and founder has spent years repeating this one magical phrase: artificial intelligence is the future. And, for a while, that logic seems completely unstoppable. Valuations go through the roof, the headlines are glowing, and these tech giants are spending like empires. But what happens when that massive spending frenzy doesn't actually kick off a permanent new era of wealth, but instead starts looking exactly like every other historical bubble we've ever seen?
So we really have to ask ourselves, what actually happens when way too much money chases way too much promise? Well, eventually, reality walks into the room and forces the market to wobble. We need to consider, what if the AI revolution doesn't collapse because AI itself is useless, because it's clearly not, but because the spending around it just became so extreme, so speculative, and entirely disconnected from any near-term returns? To really understand how a tech bubble could form around AI, we need to take a hard look at how the mechanics of this hype cycle actually operate under the hood.
Section 1. The AI spending frenzy. Fear as fuel.
Just look at the frantic mandates that are driving this current boom. It's everywhere you look. Build more centers, buy more chips, train more models, hire more engineers, scale faster, and, well, worry later. Honestly, every boardroom is repeating the exact same logic. You either spend right now, or you get completely left behind. The mindset is basically, if you aren't building AI infrastructure, you just aren't building the future. And this creates a market totally saturated with duplicated ambition. Hesitation? Hesitation is viewed as absolute death. You've got cloud providers building more, startups raising more, and entire sectors reorganizing around this one big premise. Whoever controls the infrastructure will control the profits. But here's the catch. When literally everyone is spending to win, everyone can't actually win.
There's this famous saying, and it absolutely hits the nail on the head here. Bubbles never announce themselves as bubbles. They arrive dressed as destiny. It's not just pure greed inflating this market. No, it's the sheer fear of irrelevance that's driving companies to drop billions, totally regardless of near-term returns. And AI is literally the perfect environment for this kind of fear. Why? Because the technology is genuinely real, and the pace of change is just incredibly fast. That excitement creates this massive, self-reinforcing cycle. High valuations start to justify higher spending, and then, you guessed it, that higher spending is used to justify even higher valuations.
Section 2. The obsession with compute. The new gold. Notice how the market has completely shifted its vocabulary? I mean, it's changed what it fundamentally values. In the old economy, right? We talked about gold, oil, and the classic picks and shovels. Well, in the AI economy, compute is the new gold, chips are the new oil, and GPUs, those are the new picks and shovels. The market starts rewarding companies entirely based on their AI positioning rather than actual realized revenue. Just listen to any earnings call these days. It instantly turns into this frantic race to explain who is buying what and exactly who has access to the absolute most compute power.
In this kind of feverish environment, the corporate mindset just shifts completely. Suddenly, spending is seen as bravery, and skepticism, that's failure. Any language of restraint suddenly looks weak, and caution just sounds, well, old-fashioned. This actually creates a sort of moral hierarchy that inflates the bubble even further. So you have companies rushing out to announce all these new AI initiatives that, let's be honest, might just be for optics. Or they go out and buy massively expensive server capacity they don't even need yet purely to signal how serious they are. The signal itself becomes part of the competition.
Section 3. The story versus reality. The spreadsheet always wins.
So, here's where things get real. There is a dangerous growing gap between the story being told and the actual spreadsheet. On one side, the public and investors are totally buying the story. This massive platform shift, inevitable wealth, huge glowing data centers everywhere. But then you look at the accounting reality, the spreadsheet, and it is so much more punishing. We're talking about incredibly expensive chips that depreciate rapidly, energy costs that are just constantly rising, a massive need for cooling and maintenance, and, perhaps most importantly, slow enterprise adoption. Sure, customers might be experimenting with AI, but ask yourself, are companies actually converting fast enough to pay for all this infrastructure? That exact gap between the massive money spent and the actual returns coming in, that is exactly where bubbles live.
Section 4. When the bubble bursts, reality intrudes.
Okay, so imagine this inevitable sequence playing out. Month 1, AI spending surges. Everyone is thrilled, right? The hype is real. But then, month 3, margins start falling under pressure as the bill for those massive investments comes due. By month 6, valuations compress because, surprise, enterprise adoption is proving to be a lot slower than those super optimistic projections. And finally, by month 9, heavy sell-offs begin. The early enthusiasm just gives way to delayed adoption, forcing the market to completely strip away that assumption of future certainty. The exact moment investors stop treating AI spending as a guaranteed bridge to riches and start treating it as a measurable risk, that is when the air comes rushing out of the bubble.
And the blast radius of this pop? It hits way beyond just some stock charts. It hits real life. Premature hiring gets cut, which means sudden layoffs and restructured careers, a really painful human toll. Plus, expensive physical capacity weakens. Remember, AI is tied to massive real-world assets, so utility and real estate demand just drops. We're talking about giant data centers and highly specialized equipment where the economics just evaporate overnight. It can even cause systemic exposure that hits pension funds and local economies. It is a massive physical and human commitment to a future that, well, arrived a little too slowly.
Section 5. A painful but necessary reset after the dust settles.
But here's the silver lining. After a crash, the market starkly divides companies into new, incredibly harsh categories. You've got the real winners, those with genuine, actual demand and durable economics. Then you have the hype winners, the loss makers, and those surviving purely on what we call demand theater. A reset forces absolutely everyone to ask the hard question. Are we funding actual productivity, or are we just feeding the machine that feeds the story? The survivors aren't necessarily going to be the loudest companies. They'll be the ones with the best execution and the most genuinely useful products.
It's super vital to remember this historical parallel. The dot-com era bursting didn't mean the internet was worthless, right? When a bubble pops, the public often assumes the whole story was a scam. But just because an AI bubble pops, it absolutely does not mean the underlying technology is an illusion. It just means the market got way, way ahead of itself. AI isn't disappearing in this scenario. It's getting a reality check. It's being reset. The companies left standing will be the ones who figure out how to integrate AI into existing workflows in ways that are genuinely useful, making the economics actually work.
Which brings us to this final, provocative thought. Can a real revolution actually survive without all the hype? A real technological shift takes time, discipline, and solid economics. But when the spending starts outrunning the reality, the future stops being a promise, and it starts being a test. A strict test of which companies are building lasting, actual value, and which ones were just riding the wave of an overpriced present. Thanks so much for joining me for this explainer, and hey, keep looking closely at those spreadsheets, not just the stories.